Hello fellow traders. FOMO in trading is fear of missing out, the sense that other traders are profiting while you're not, which pushes traders into impulsive decisions. Emotional trades driven by FOMO often result in buying late at extended prices and selling early when fear peaks, turning buy low, sell high into buy high, sell low. Today we're going to get into how FOMO buys tops and sells bottoms. In this session, we're going to get into fear of missing out and how it systematically pushes traders into buying high and selling low. You already know the feeling. A stock is ripping, everyone is posting gains, and you feel like you're the only one missing out. That emotion, if we let that drive our decisions, is what turns strong moves into bad trades. And we'll use the Warner Brothers Discovery example and three tools: volume, RSI, and MACD, to see how exactly where FOMO shows up on the chart and how to build rules so FOMO stops buying the top and selling the bottom. Today we're going to get into how FOMO buys tops and sells bottoms by a pajama trader. Let's get into it. What FOMO looks like in markets. In markets, FOMO appears when traders see a fast move and feel pressured to join because it seems everyone else is making money. So they enter after big runs instead of during the quiet basing phases. The same emotional impulse drives panic exits after sharp drops, and fear of further losses overwhelms, and long-term plan leads to selling into weakness at near local lows. FOMO trades cluster as emotional extremes, not during calm conditions. On the way up, the thought process is, if I don't get in now, I'll miss the whole move. So people chase after several strong candles. On the way down, the same fear flips direction. If I don't get out now, it could go to zero. So they dump during the flush. The result is very consistent behavior, buying strength too late and selling weakness too soon. Going to get into Warner Brothers, the case study. So if you wanted to catch the breakout and not be in FOMO zone, you'd catch it with some volume here at 1256, maybe exiting about 19. But if you chased it FOMO here, you got roughly a $6 gain before it turns over. But it doesn't look like it's going to get any higher because after you got this volume here, it started to tick down. The Warner Brothers daily chart shows a long base followed by a strong breakout and extended uptrend, giving a clear visual example of how price, volume, RSI, and MACD behave during the trend. Reading these indicators together allows us to separate early planned entries with good risk reward from late emotional driven entries and exits caused by FOMO. And this Warner Brothers Discovery on the daily chart time frame, notice how the long consolidation, the breakout, and the strong run that follows. Under pressure, you see that the volume at the bottom, RSI in the middle, and MACD beneath that. And we see, as you can see through the chart, we're building as the trade is going live, and each indicator identifies where the process-driven trader would act and where the crowd-driven FOMO is likely to pile in or bail out. Volume, buying conviction. Large spikes in volume during the breakout phase shows unusually strong participation and real demand, often from larger or better informed traders rather than scattered retail. When heavy volume appears on the up days coming out of a base, it signals buying conviction and suggests that early, prepared buyers are entering before a majority of reactive traders. Focus on the volume first. During the base, volume is moderate, and then on the breakout you'll see the tail of a spike. That is how market's shouting is that new money is coming in. This is where traders with alerts, plans, and levels are executing. Price is just leaving the base. Volume confirms that the move is real and risk reward is still favorable. This is an important point that is not when FOMO traders tend to enter This is when systematic traders get in. RSI strengthens versus exhaustion. RSI is a 0 to 100 oscillator that reflects the speed and magnitude of recent price changes, with readings above 50 broadly associated with bullish momentum and readings below 50 with bearish pressure. Readings above 70 are commonly considered overbought, and especially after a long advance, warn that the upside is becoming limited. At the same time, FOMO traders feel the strongest urge to buy. Now look at the RSI. Think of 50 as the midpoint, and below it sellers have the momentum, and above it buyers do. And in Warner Brothers Discovery, the RSI dips and then starts climbing through the mid-range just as the volume builds and price breaks out, which is a classic confirmation of a new uptrend. Later, RSI pushes towards or into the overbought zone. That does not guarantee a reversal, but tells you that the move has been exceptionally strong. And this is exactly when social media is the most euphoric and FOMO is at its loudest, even when structurally the trade is becoming riskier. MACD confirming the trend. The MACD compares the fast and the slow exponential moving average to gauge trend strength and direction, with bullish signal and often occurring when the MACD line crosses above the signal line and the historical turns positive. A rising MACD histogram above 0 indicates an increasing bullish momentum, but when the lines and the histogram become extended, it usually marks a mature trend that is vulnerable to a normal pullback, even when it starts feeling strong. MACD is our trend engine. The MACD line crosses above the signal line and the histogram flips positive. It tells us that buyers are taking control. And in this chart, the bullish cross happens early in the run near the base. As the price keeps rising, MACD continues higher, and then the histogram stretches. By the time the MACD is fully extended, anyone buying is late to the party. And if you got in or got interested after this indicator has been bullish for a while, you're not trading the start of the move. You're trading its emotional peak. From FOMO entries to rules-based entries. Rational entries usually occur near the base in the first breakout, when volume is expanding out of consolidation. RSI is moving up through the mid-range, and the MACD just turned bullish. So the trend is young, price is still close to support, and the risk reward is attractive. FOMO entries tend to happen much later, after multiple large green candles and when the chart looks the safest, but the price is far above support. RSI is overbought, MACD is already extended, leaving poor risk reward and making even the standard pullback feel like a crisis. And as at that pullback unfolds, late buyers who never define their risk often panic and sell into the weakness simply to stop the emotional pain. Just as indicators are cooling back towards the neutral and prices approaching more attractive support levels that may appeal to disciplined traders. The way to escape this pattern is to turn the indicators into simple rules. Avoid opening new longs when RSI is overbought and the price is parabolic, and favor setups that where the RSI is emerging above 50 near support with fresh MACD bullish cross, rising volume. So the entry lines up with the early trend developing instead of emotional extremes. Now look at how these indicators separately plan entries from FOMO entries. Down in the planned entry zone, volume is starting to surge out of the base. RSI is moving above 50 and the MACD has only recently turned positive. You're close to support, your stop can be logical, and you're clearly in the trend. Up in the FOMO zone, price is long way above support. The RSI is stretched, the MACD has been screaming higher for a while. That's when the chart looks safe to the crowd, but structurally, this is the most dangerous place to start a new long. When inevitable pullbacks from the FOMO area, traders who chase late and size too big experience immediate pain. With those predefined stopped or planned, they can ride the move down and they cannot take it anymore and then sell into weakness. Ironically, they tend to exit as the RSI and MACD are cooling off and the price returns to levels where a rules-based trader might begin to look for new entries. The way to stop FOMO from buying tops and selling bottoms is not to guess every turn, but enforce simple indicator-driven rules where you would not open trades if you would not open trades if the indicators don't line up. Now, if you found value in this video, give it a like. Share with other traders looking to buy FOMO stock, not buying into FOMO stocks, and subscribe for more market edge videos like this one. Thanks again for watching.